Hello and welcome to All Indians Matter. I'm Ashraf Engineer. Over the past few weeks, talk of an induced recession in the US has been gaining ground. What it means is that given the red hot inflation, the US Federal Reserve has put in place a plan to raise interest rates that would create a short, mild recession that would cool inflation to manageable levels. The Federal Reserve hasn't accepted that it's trying to induce a recession, but many experts believe that it is imminent, starting either late this year or in mid 2023. So, why am I talking about something likely to happen in the US on this podcast? It's because India would not be immune to economic turbulence there. In fact, a recession in the US would affect you profoundly.
All Indians matter.
Recently, the Federal Reserve raised the interest rate by 3/4 of a percentage point, the steepest rise since 1994, and its most aggressive move against inflation, which has been sparked for various reasons. From Russia's invasion of Ukraine to rising energy prices to supply chain disruptions caused by the COVID-19 pandemic. Inflation is a severe risk to the average citizen, and the near consensus among economic experts is that the Federal Reserve will keep hiking interest rates in order to reduce money supply and thus break inflation. Only they could well risk breaking the US economy, which is the engine of the world representing 30% of global GDP. Inflation is the latest global pandemic. A Pew Research Center analysis of 44 advanced economies found that in nearly all of them, consumer prices rose substantially after the pandemic. In 37 of these countries, the average annual inflation rate in the first quarter of this year was at least twice that of the first quarter of 2020. In 16 countries, first quarter inflation was more than 4 times that level. This has affected consumer spending across the world, impacting the post-COVID recovery. This year, the United Nations Conference on Trade and Development expects global growth to slow to 3.6%, leaving world income 3.7% below the pre-pandemic trend. This translates to an estimated income loss of $13 trillion across the world between 2020 and 2022. It is in this context that we must view the US raising interest rates. Loans will get costlier in the US, and the consumer demand and spending would reduce, and eventually so would prices as a response to that reduced demand. US money managers would start pulling out money from developing economies, which would impact stock markets, their overall economic growth, and it would depreciate their currencies. It would also reduce their foreign exchange reserves. India would certainly see all these impacts, as well as a decline in foreign direct investment. The loans the country takes to finance its growth and social programs would also get costlier. This year, the Indian rupee has been among the worst performing Asian currencies, getting within touching distance of the 79 rupees to the dollar mark. Compared to net positive investments of rupees 25,752 crore in 2021, foreign investors have pulled out a net rupees 1.92 lakh crore in the first 5 months of 2022. Meanwhile, rising crude oil prices continue to pressure the currency and the cost of living. The Reserve Bank of India is not immune to raising rates either. Earlier in June, it hiked the key interest rate to 4.9% from 4.4% as a response to the stubborn inflation the country has been experiencing. The US's slowdown will certainly hamper India's growth trajectory. The US constitutes around 18% of India's merchandise export market and over 60% of India's IT and IT-enabled services exports. In fact, the IT industry will be among the worst hit. A survey of CIOs by global brokerage and research firm JP Morgan said that IT budgets would contract, and 39% of the CIOs expected to delay or defer their IT purchases in the second half of this year. The report indicated that CIOs using Indian IT companies like Tata Consultancy Services, Infosys, and Wipro would cut their spending with them. This would affect jobs and also the share prices of these firms. IT firms are struggling already, with shrinking margins, and a cut in US spends would mean more bad news. Other than IT and IT-enabled services, textiles, jewellery, handicrafts, and leather industries would suffer losses too. Perhaps the worst affected would be the service sector as a whole, of which business process outsourcing, IT, ITeS, etc. are a part. but which also includes trading, financial and professional services, education, healthcare, and so on. Services contribute about 54% of India's GDP. Again, the key worry will be job losses. Perhaps the only silver lining is that the US recession is at least 6 months away and will most likely be mild. It's also likely to be short lived. But make no mistake, India will not escape its impact.
Thank you all for listening. Please visit allindiansmatter.in, that's ALLINDIANSMATTER.in for more columns and audio podcasts. You can follow me on Twitter at Ashraf Engineer, that's ASHRAFENGINER, and All Indians Count, that's ALLINDIANSCOUNT. Search for the All Indians Matter page on Facebook. On Instagram, the handle is All Indians Matter. Email me at editor@allindiansmatter.in. Catch you again soon.